The accounting equation, a comprehensive overview. The fundamental accounting equation, also referred to as the balance sheet equation, forms the foundation of the double-entry bookkeeping system. This equation is expressed as assets equals liabilities plus owner's equity. Let's delve deeper into each component. 1. Assets. Assets are economic resources owned or controlled by a business that are expected to provide future economic benefits. They are typically classified into A. Current assets. These are assets that can be converted into cash within one operating cycle, usually 1 year. Examples include cash and cash equivalents, accounts receivable, inventory, prepaid expenses. B. Non-current assets, or long-term assets. These are assets not expected to be converted into cash within 1 year. Examples include property, plant, and equipment. Intangible assets, patents, trademarks, goodwill. Long-term investments. 2. Liabilities. Liabilities are financial obligations that a business owes to external parties. They represent claims against the company's assets. Liabilities are categorized into A. Current liabilities. These are obligations due within one operating cycle. Examples include accounts payable, short-term loans, accrued expenses, unearned revenue. B. Non-current liabilities, or long-term liabilities. These are obligations not due within 1 year. Examples include long-term loans, bonds payable, deferred tax liabilities. 3. Owner's equity. Owner's equity represents the residual interest in the assets of the entity after deducting liabilities. It's essentially what would be left for the owners if all assets were liquidated and all liabilities paid off. Owner's equity includes A. Contributed capital, the amount invested by the owners in the business. B. Retained earnings, accumulated profits that have been reinvested in the business. For corporations, this is often called shareholders' equity and may include common stock, preferred stock, additional paid-in capital, retained earnings. The expanded accounting equation. To provide more insight into the operations of a business, the basic accounting equation can be expanded to assets equals liabilities plus owner's equity plus revenue, expenses, drawings. Where for revenue, income generated from the sale of goods or services, or from other business activities. 5. Expenses. Costs incurred in the process of generating revenue. 6. Drawings. Withdrawals made by the owners for personal use, applicable to sole proprietorships and partnerships. Key principles. 1. Dual aspect concept. Every transaction affects at least 2 accounts, maintaining the balance of the equation. 2. Balance sheet equality. The total assets must always equal the total of liabilities plus owner's equity. 3. Accrual basis. Revenues are recognized when earned and expenses when incurred, regardless of when cash changes hands. For going concern, the equation assumes the business will continue to operate in the foreseeable future. 5. Monetary unit. All items in the equation are expressed in monetary terms. Understanding and applying this equation is crucial for preparing financial statements, analyzing a company's financial position, making informed business decisions, ensuring the accuracy of accounting records. The accounting equation serves as an error detection tool in the accounting process. If at any point the equation is not balanced, it indicates that there's an error in the recording process that needs to be identified and corrected.